We have now with us on the show Sonal Verma, who's India economist at Nomura Financial Advisory and Securities. Sonal, to begin with, just addressing, rather looking at the inflation picture. Now, there is this expectation that diesel prices will be raised by 1 litre per month for the next few months in order to right price the fuel. If you add to that, the various MSPs that have been that are being tinkered with, the MSP on wheat a fortnight ago, for instance, should we expect that inflation is going to remain at elevated levels for the foreseeable future?
In a way, yes. But I think, as compared to the last 6 to 9 months where inflation has been, closer to 7.5% to 8%, we are sort of getting into a period which is actually a good period relative to what it has been historically. We are getting into a period where we do expect headline inflation to remain benign, which is, around 7% or so. But the factors that you mentioned, the diesel price increase, the MSP increases, which will actually probably rise much more in the middle of 2013, and the fact that currency continues to depreciate, there are efforts to restart the investment side, which means that there would again be some demand that will kick in at some point in time. All those factors suggest that the phase of lower inflation that we're seeing right now is sort of, more a temporary patch rather than the start of a new trend. But right now, yes, the next 3 to 6 months is a period where we do expect inflation to remain benign.
Sonal, afternoon. Now, some of the economists that we speak with are beginning to scale down their expectations on the rate cut front against an earlier expectation of 100 to 150 basis points in the repo rate cut in 2013. They now expect rates to go down by only 50 to 75 basis points. Do you share the same view?
Our view actually has always been that rate cuts in this cycle will be very limited. I think, the fact is that CPI inflation, WPI inflation, all inflation measures are still sticky at elevated levels. The current account deficit is at a record high. The fiscal situation continues to be of worry. So this rate cutting cycle, despite all the growth slowdown that has taken place, is very different in terms of the other macroeconomic indicators. In fact, India's potential growth itself has slowed down, so one should not just overreact to the headline growth number. Our expectation, therefore, is another 50 basis point of rate cuts in calendar year 2013, starting with the 25 basis point at the Jan policy. But again, I think the rate cutting cycle is closely linked to the inflation picture. If the next 3 to 6 months of inflation picture are benign, which is our base case view, we do think that the rate cuts will be more in the first half window. Second half of 2013, we think, can be quite different from the first half, with second half both inflation picking up and the rate cutting cycle again pausing.
Right. Now, Sonal, even if we do see the policy rate go down by maybe 100 to 150 basis points, as some economists continue to expect, should we then expect that banks will be constrained in their ability to lower lending rates simply because the widening wedge between deposit growth and credit growth is going to ensure that deposit rates continue to remain at elevated levels?
Well, the transmission to an extent has been clogged, or at least it has been muted. Historically, what we've seen is, for instance, if there's a 100 basis point reduction in the policy rates, bank lending and deposit rates go down by half of that, so 50 basis point transmission takes place. So similarly, I think, if we do see 50 to 75 basis point reduction in RBI's policy rates, the actual reduction in the cost for borrowers, while the direction will still be down, the extent of lowering of, cost of funding for borrowers will definitely, it looks like based on historical comparisons, will not be, more than half of that, so 25 to 50 basis points. So to that extent, you're right, the transmission will be very limited, and therefore, on an average, cost of capital in this cycle that we are in right now will actually be much higher than what it has been in the previous cycles.
Sonal, what are you expecting on Friday when the IIP numbers are put out?
Well, we are expecting a negative reading. Our projection is negative 3% for this month. The main reason really is loss of working days because of Diwali, the fact that Diwali was in October last year and in November this year. So it's more sort of base effects and working day plays, but we do think it's going to be a big negative reading this time around. It's also one-off. If you look at the underlying trend on the industrial cycle, then industrial growth is growing at about 0.5 to 1% on a sort of moving average basis. So that's the underlying trend, but Friday should be a negative reading.
And come the 14th, what are you expecting from the WPI inflation?
Not much really. Our expectation is that it's going to be broadly at the November levels. So 7.2 to 7.3% on headline inflation and around 4.5 to 4.6% on the core inflation level. So not much deviation from the previous month levels, mainly because primary articles inflation have continued to moderate, and while the momentum on core inflation will pick up in our view because of the lagged impact of currency depreciation, the base effects are positive. So the year-on-year rate should not swing a big surprise on either direction.
Sonal, the market seems to be coming around to the belief that the centre will indeed stay within the stated 5.3% number on the fiscal deficit. Are you convinced that they will stay within that number at Nomura?
Well, within 5.3 in our view is close to impossible. Our own official projections are 5.8. But one interesting trend that is clearly visible in the last 3 months is that the government is significantly actually lowering its expenditure. So if you look at the total spending growth during April to August was almost 20% year over year. This 20% growth rate has actually fallen to around 5% between September to November. So, there's been some delay in payments, plan expenditure has been cut, some capital expenditure has been cut. But through various means, the government is actually going slow on expenditure. So while revenue slippages are still there, based on the run rate, I think, the tracking rate on fiscal deficit is anywhere between 5.5 to 5.8%. 5.3% clearly is still not possible.
So would you then be of the view that they will announce, extra borrowings in this quarter?
Well, it may not happen for the pure reason that, in any case, government has been doing additional borrowing through the treasury bill route. Plus, since they're going a bit slow on spending, actually they're sitting on a huge surplus right now. There was some carry forward of cash surplus from the last year itself. There could be additional, 2 odd extra borrowings, but in any case, we would not be too worried about that if that happens.
Sonal, what's your view on the overall GDP growth, and do you believe that as long as the GDP growth story is led by consumption demand and not investment demand, that the slowdown is not likely to reverse?
Well, our forecast for this year is 5.5 and 6.2 for next year. I think, our view is that it cannot be another consumption-led growth recovery in India. We've seen too much consumption, not enough investment, and one of the reasons why we are in this problem of high inflation and a high current account deficit is that the consumption investment gap has been widening too sharply. If we need to correct some of these imbalances, then the recovery in India has to be more investment-led and not consumption-led. Now, if you look at the investment side, global growth is still weak and the cost of capital is still high. So we do not think that a new capex cycle like it did begin in 2003-2007 phase is possible. The initial conditions for that are not in place. But what can happen is some of the existing projects which have been stuck because of slow government approvals, there can be some debottlenecking on that front. So, our view is that it has to be more investment-driven recovery and not consumption-driven recovery. If it is another consumption-driven recovery, then we would be worried.
There also has been a scenario with falling exports despite that 20% drop in the exchange rate, the declining investments, despite seeing a consistent rise in the domestic consumption. Do you think perhaps this suggests that, the slowdown come inflation scenario for the Indian economy is a bit structural in nature?
It is sort of structural, yes. If you see on the growth front, potential growth has slowed down across all economies globally. So it's not possible for India to grow at a faster pace when globally things are slowing down. So there has been a trend shift down in India's potential growth rate. Investments will pick up, but again, for that to happen, cost of capital has to come down, global environment has to be a little less uncertain, all of which will take some time. It's not going to happen anytime soon. And inflation, in our view, is largely driven by what's happening on the food front. And what we've seen in the last 3-4 years is that the trend food inflation has moved up from 5% per annum to 10% per annum. And as long as food inflation stays high, and food is a big component for any household in India, expectations remain high, and which basically causes inflation to be sticky. So again, while we are celebrating the fact that WPI inflation has come off, if you look at the CPI inflation numbers, actually they've been very sticky at 9.5%. So that tells you just how structural the issue is on inflation in India.
All right, Sonal Verma, thanks very much for joining us on the show and talking to us about some of those macroeconomic trends playing out and also what the outlook over there is.